In October 2025, South Africa successfully negotiated its removal from the Financial Action Task Force grey list. Across the industry, the immediate reaction was to treat this exit as a finish line, a signal that the regulatory pressure would ease and operations could return to the pre-listing status quo. That assumption miscalculates the state's actual position. The real catalyst driving current market restructuring is the next FATF mutual evaluation, scheduled to commence in mid-2026. The window between the 2025 exit and October 2027 final report is filled by two massive legislative blocks, the COFI Bill and the AML-CFT Amendment. The evaluation won't grade paper frameworks. Assessors will test measurable outcomes, investigations, prosecutions, and sanctions. To meet that standard, the state is advancing these two landmark bills simultaneously, effectively rewriting the country's entire financial regulatory architecture within a single parliamentary cycle. The dual targets are clear: eliminate the regulatory arbitrage that shields modern financial technology and permanently close the channels used for illicit financial flows. This captures banks, long and short-term insurers, and asset managers, and every non-bank financial institution operating in the country. Cross-border compliance is a highly mechanical process. These new bills force domestic operations to snap into a rigid, zero-tolerance grid that international counterparties can verify. The compliance infrastructure that businesses were forced to build during the graylist period is now a competitive asset. Those capabilities must be weaponized, not wound down. Surviving the 2026 evaluation requires adapting to an entirely new dual-pillar regulatory architecture. Minor tweaks to existing legal frameworks will fail the stress test. The first pillar was set in motion in April 2026, when the Minister of Finance gave formal notice of introduction for the Conduct of Financial Institutions, or COFI Bill, to the National Assembly. Historically, South Africa's financial laws were fragmented. Regulations were built in silos, tied strictly to specific legacy products, like traditional bank accounts or standard insurance policies. This product-based system breaks down against modern financial technology. Services that don't fit old definitions exist outside the regulatory net. This creates regulatory arbitrage. Tech-enabled services use tactical evasion to operate without direct oversight from the Financial Sector Conduct Authority. The COFI Bill solves this by discarding the silos. It creates a single, holistic framework governing the market conduct of the entire financial sector. The mechanism it uses to do this is called activity-based licensing. COFI demolishes the old product structures and implements a horizontal grid. Unregulated tech nodes are instantly absorbed and locked into the system. Under this model, an institution's compliance burden is no longer assessed by its product name. It is assessed strictly by the nature of the activity it performs. The legal definition of a financial product is expanded to include any arrangement that produces a similar outcome to a traditional service, regardless of the technology driving it. This single clause definitively captures the growing layer of embedded finance. Buy now, pay later platforms and digital wallet operators are pulled entirely out of the gray zone. For the consumer, this architecture guarantees that the overarching mandate for all these captured entities is fair customer treatment and market stability. On a domestic policy level, COFI expressly requires that every captured financial institution maintain transformation policies aligned with the Financial Sector Code. This integrates broad-based Black economic empowerment compliance obligations directly into the market conduct regulatory framework for the first time. By transforming compliance from a narrow, product-specific checklist into a universal mandate, COFI ensures that no financial activity, no matter how technologically advanced, can hide from regulatory oversight. Moving on a parallel track is the second pillar, the General Laws Anti-Money Laundering and Combating Terrorism Financing Amendment Bill 2026. The scope of this draft bill is sweeping. It proposes targeted amendments to 5 distinct pieces of national legislation simultaneously. By centralizing data from the Companies Act, the Trust Property Control Act, and the Financial Sector Regulation Act, separate legal domains are weaponized into a single enforcement hub at the Financial Intelligence Center. The primary objective of this data convergence is exposing ultimate beneficial ownership. These rules are designed to strip away the anonymity of corporate shells, preventing criminals from concealing their financial interests behind layered legal entities. To enforce this transparency, the bill introduces the most aggressive tool in the state's arsenal: formalized lifestyle audit powers for the FIC. A lifestyle audit relies on a stark, undeniable comparison. It directly measures legally declared income against visible physical reality. The FIC cross-references a subject's tax filings and stated salary against actual luxury assets, properties, and daily expenditures. If the math does not align, the audit triggers. This expands the FIC's mandate from tracking suspicious transactions to proactive, invasive financial auditing. The amendments also address specific historical vulnerabilities, particularly within nonprofit organizations. During earlier evaluations, the FATF specifically flagged the South African NPO sector as a critical, lightly monitored channel for illicit financial flows. The 2026 draft bill grants the NPO Directorate expanded monitoring and direct enforcement powers, permanently closing that vulnerability. With these amendments, the state shifts from passively logging corporate data into operating an active enforcement engine capable of piercing the corporate veil at will. Look at the new architecture as a whole. This dual-pillar system creates a highly secured domestic grid that international capital must navigate. When foreign banks and investors conduct due diligence, they will scan for compliance in beneficial ownership and technology integration before releasing capital. And the mid-2026 FATF mutual evaluation is arriving specifically to test if this machinery is actually functioning or if it exists solely on paper. For institutions with cross-border operations, the current parliamentary tabling is the trigger. Compliance restructuring must happen now, not after the fact. Waiting for final promulgation is a strategic error. The evaluation window is open, and the timeline to adapt is already closing. South Africa's post-gray list posture is defined by continued intensification. Survival in this financial ecosystem requires mastering an environment where relentless regulation and aggressive enforcement are permanently intertwined.